It's rare that the overall investment strategy someone starts their investing career with is the same one they end up using over the long term. And some investors start without any overarching philosophy other than, I want to invest and make my money grow. And that's okay. You will likely continue to learn more about investing for many years. In this video, we'll highlight some famous investors to give you a sense of just some of the overall investment philosophies out there. Warren Buffett. Warren Buffett is one of the most famous investors in history. His fame is owing to his very long track record of high returns, his buy and hold philosophy, and his personality. He freely shares his insights and wisdom in an annual shareholders letter for his holding company, Berkshire Hathaway. Berkshire Hathaway trades in the stock market but is quite unique. Normally, when a stock's price gets very high, the company can decide to split the shares to bring the price down while increasing the number of shares available. But Berkshire Hathaway A shares have never split. In early 2021, they reached $400,000 per share. Berkshire Hathaway is more like an actively managed, exchange-traded fund than it is a single stock. That's because while the company was originally a textile company when Buffett first bought it, eventually he turned it into an investment holding company. Berkshire Hathaway itself owns many different companies in turn. According to their 2020 annual report, the overall cumulative gain for the S&P 500 index from 1964 until 2020 was 23,454%. But for Berkshire Hathaway, it was 2,810,526%. When you look at the annual compound returns, the S&P 500 earned 10.2% during this time, and Berkshire Hathaway earned 20%, so about double the compounded return. But when you add in 56 years of strong returns, it really highlights the power of time in growing your wealth. Buffett is known for looking for companies he believes are underpriced, are strong businesses he would be happy to own forever, and then holding for very, very long periods of time. This type of strategy falls into the value investing category. Peter Lynch. Peter Lynch shot to fame for growing a mutual fund he managed into the largest mutual fund in the world at the time, the Fidelity Magellan Fund. As the name might imply, he was always exploring the markets for stocks to buy. Lynch used a variety of different investment styles, but may be most famous for making growth at a reasonable price, or GARP, popular. This is a bit of a mix between growth investing and value investing. It involves looking for fast-growing companies that haven't had their share prices also grow too quickly yet. In other words, he was mindful of trying not to overpay for these fast-growing companies. Lynch also popularized the idea of investing in what you know, suggesting that people who work in a specific industry might be able to understand the stocks of companies in those industries better than the average investor. Or perhaps they're better at noticing when a new company is very popular in their cities. Lynch famously invested in Dunkin' Donuts after being impressed with their coffee and seeing how busy a lot of their locations were for this new at the time chain. He then dug into the company's financials and bought the stock, and it went on to become one of his better performing investments in his very stellar career. John Bogle. John Bogle was a pioneer and champion of low-cost passive investing. He built the Vanguard Group, which was responsible for creating index funds that allowed retail investors to track the market returns at very low cost. He encouraged investors to invest early and often, keep portfolios and strategies simple and low maintenance, reduce costs as low as possible, and to not try to outsmart the market, but rather to simply track the market. The simplicity of this approach has led to superior returns for many investors in a low-maintenance strategy, but don't let the simplicity fool you. It's often been said that index investing is simple, but it's not easy. As with any investing strategy, one of the hardest aspects of being a successful investor is being able to create and stick to a plan. Many investors make the mistake of changing strategies when they seem to stop working. But all strategies exhibit periods of general outperformance and underperformance. It's those periods of underperformance that really test the mettle of investors.